Hi, I'm Scott Hoppy, and today I want to look at S-Corp owners' pay and really drill into that reasonable compensation conversation. So many sole proprietors or single member LLCs um, or new business owners in general wonder if they should be an S-Corp. They hear about the tax savings, and maybe they've explored and they realize, the main reason you get tax savings is because you can control the amount of salary you pay yourself. And when you control your salary, you can control your exposure to employment taxes. So you may begin to ask yourself, okay, well, how much do I pay myself? And the answer to that is a reasonable amount. So we ask ourselves, well, what's a reasonable amount? And that question's really what's driven a lot of tax court cases, battles with the IRS, and it's an important factor or an important number to determine. And what we're going to do is kind of go through how we would get a reasonable compensation amount. But before that, let's take a look at an example that really illustrates uh, what an S corp owner is trying to do when they're looking to pay themselves the least amount as possible, but still being reasonable. So Joey's the 100% owner of a California S corp. He made $100,000 before salary. If he takes everything out of salary, it costs him over $15,000 in employment taxes. If he instead takes the money out as a distribution, he pays no employment taxes. So as an S corp, you have two ways to take money out. One is salary, one is distributions. It's in the S corp owner's interest to pay themselves more distributions than salary because the salary costs them a lot of money. But the IRS is at odds with you, with you wanting to reduce your salary potentially, to zero because you don't want to pay any of the taxes. And so what's kind of come out of court cases is a reasonable compensation test and kind of some factors that go into it. So there's 9 factors total that the IRS has summarized, but we really drill into 3 of them. And the 3 questions we ask that represent the factors we'll look at is what's the fair market value for your role or a similar one at another firm or company? Is the owner paid more than the next highest compensated employee? And is your pay in line with a 46 to 54 split between distributions and payroll? You also kind of hear about a 40-60 split. That's a very general one. So to get that exact split number, your gut check can be the 46-54, but you want to make sure you're using market numbers that are representative of companies in your industry and in your region. So let's go ahead and jump into some examples here and see how this works. Joey's an architect, a California resident, and his business is formed as an S corp in California. In 2018, he made $300,000. This is before he paid himself anything, and he has 2 employees, each paid $60,000 a year. So what's Joey's reasonable compensation? Well, we're going to give Joey a pay range of $60,000 to $162,000 and that's a really big range. But we're going to recommend that he set his salary to a fair market value of $95,000. So looking at test 1, which is the fair market value for the role, in this one it was $95,000. That's based off of research and of similar salaries in the area and also industry reports that show salary for firm sizes. So Deltec has that report for architects, and that's a resource. For other industries, Robert Half has some salary reports as well. Test 2 is knowing how much do we pay the next highest paid employee. In this example, it's $60,000. And then test 3, the 54 to 46 split, we would get to $162,000. Well, it's not in our interest to pay him 162,000 because he would overpay employment taxes. We can't pay him under $60,000 because that's under fair market value, and that would be less than his highest paid employee. So in this case, we say, hey, Joey, we should go for fair market value of 95,000. And by relying on that test and not test 3, he's going to save himself over $10,000 a year in taxes, in employment taxes. Let's go ahead and adjust this a little bit and see what we get. So same facts as before, but now Joey makes $100,000 before determining his salary. Now we recommend that he set a salary between $54,000 and $64,000. So what happened? Test 1 stays the same because his fair market value is still $95,000. Test 2 stays the same because his highest paid employee is still $60,000. But test 3 now says you only need to pay yourself up to $54,000. So what we'll want to do is dive into that and really determine, should we be paying $54,000 or $60,000 in this example, and we'll go between that range. If we're talking to Joe, we'd probably start peeling back and seeing about what income flow is going to look like and how active we want to manage his salary. Maybe we'll set it up a little over 60, so that way we don't have to touch it each year. Because if his income jumps up, test 3 would jump up, and he would have to keep revisiting his payroll amount throughout the year, which may be more management than he wants for this. But let's move on to a third test. And we're still looking at Joey, same facts as before, but now his highest employee makes $200,000. Joey's new role has a fair market value of $200,000. He's still making $300,000. Now we're going to recommend he set a salary to $162,000. Because test 1 and test 2 have both brought the bar up quite a bit. We don't want to overpay him and match those items when we can rely on test 3, which is going to allow us to support him paying himself under fair market value, again saving on payroll taxes. That's a big deal for him and helps out a lot. So that's an overview of the 3 factors that we really look at. And the takeaway for you, and what I want you to walk away with, is S-Corp owners want to have the lowest salary possible. The IRS wants you to have a high salary. You want to be able to support a reasonable compensation so you don't get in trouble and get penalties and have to go fight the IRS on what your reasonable compensation is. The best thing you can do is, because nothing's foolproof, is go out and support the number that you're coming up with. And you can use these 3 tests. There's a 4th one in there, though, too, that we really work with, and it's, can we argue pay discrepancy based off specific factors, thinking like your experience, duties, responsibilities. But if you have a narrow example, you may be able to get this number yourself. Otherwise, I'd be happy to help you out. Just email Scott Blue, say you saw this, and we'll set something up to talk with you. Thanks for your time, and have a nice day. Bye-bye.